You just worked 160 hours. You gave a full month of your life, your mornings, your focus, your energy, to a job that promised you $3,200. So you check your bank account on payday, and the number staring back at you is $2,407. You didn't buy anything yet. You didn't spend a single cent. You literally just received the money, and almost $800 is already gone. No one stole it. No one made a mistake. The system did exactly what it was designed to do. And the thing is, that missing money, that's not even the beginning of the story. Because even the $2,407 that actually hit your account, that number is being quietly chipped away right now, in ways most people won't notice for years. So here's what I want to do today. I want to trace every single dollar you earn, from the moment it's promised to you, through every hidden layer it passes through, and show you, for the first time, how money actually works. Not how school said it works. Not how your parents vaguely explained it. How it really operates as a living system, one you're already inside of, whether you understand it or not. Let's start. Most people think about money like this. You earn it, you spend it, and if you're lucky, you save a little. Earn, spend, save. 3 steps. Simple, right? But that's like saying the ocean is just water. Technically true, but it completely misses the currents, the tides, the creatures living inside it, and the moon pulling on it from 240,000 miles away. And here's a number that should stop you in your tracks. Right now, about 37% of Americans can't even handle a $400 emergency without borrowing money or selling something. $400. That's a car repair, a surprise medical bill, a broken phone. More than a third of people in one of the wealthiest nations in human history are one bad Tuesday away from a financial crisis. And it's not because they're lazy or irresponsible. It's because nobody ever showed them the full picture of the system they're living inside of. Because money is not a line. It's not earn, then spend. Money is a circulatory system. Imagine it like blood flowing through a massive body. Your paycheck isn't the beginning, and your rent payment isn't the end. Every dollar you touch is on a journey that started long before it reached you and continues long after you let it go. There are institutions taking a cut before you see it. There are banks redirecting it while you sleep. There are invisible forces shrinking its power year by year. There are systems scoring you, personally, based on how you handle it. And there are mechanisms that, if you understand them, let you put your money on a kind of conveyor belt where it grows without you lifting a finger. The problem isn't that this is complicated. It's that no one ever shows you the full picture in one sitting. You get pieces, a lesson on taxes here, a confusing article about interest rates there, but never the connected story. So that's what this is. One connected story. We're going to follow your dollar from the moment you earn it, through every twist and turn of the system, all the way to the end. And once you see it, once you see the whole thing, you'll never think about money the same way again. And it starts with the very first bite taken out of your paycheck, before it even hits your hands. Let's go back to that paycheck. Your employer agreed to pay you $3,200. But your employer doesn't just hand you $3,200. Instead, before the money ever moves towards your bank account, it passes through a toll booth. Actually, several toll booths. The first one is federal income tax. The government takes a percentage of your earnings to fund the things that theoretically keep the country running. Roads, the military, federal agencies, public programs. Depending on how much you make, that slice is somewhere between 10 and 37%. For most working people, it's somewhere in the middle. So right there, a chunk disappears. But the federal government isn't the only one at the toll booth. If you live in most states, your state also takes an income tax, a separate cut on top of the federal one. Some states take a little, some take a lot, and a few, like Texas and Florida, don't take any state income tax at all. Which, by the way, is why you hear about people strategically moving to certain places. Then there are payroll taxes. This is the one that really surprises people. Before your paycheck was even calculated, your employer was already paying a tax just for employing you. And you're paying a matching portion. This funds Social Security and Medicare, programs designed to support you when you're older. So you're paying into a system now that you won't use for decades. Add it all up, and that's your answer. That's the gap between $3,200 and $2,407. Nobody stole it. The system routed it automatically, like a toll road where the fees are deducted before you even realize you're driving on it. Now, here's what makes this interesting. You finally receive your reduced paycheck. You deposit it, or it lands via direct deposit, and you think, okay, at least this money is mine now. It's sitting safely in my bank account. But is it? Here's something most people don't realize. The money in your bank account isn't really sitting in a vault. Not most of it. We like to imagine banks as these secure places, like giant safes where our money just waits for us. But that's not what a bank actually does. A bank is more like a flow system. Money comes in from people like you, and almost immediately it starts moving back out, as loans. Someone gets approved for a home loan, someone else takes a business loan. And the money they're using? Part of it could be yours. This is how the system works. Banks only keep a small portion of total deposits with them. The rest is constantly being used, circulating through the economy. This system is called fractional reserve banking, and it's one of the most important and least understood parts of the financial world. Because banks don't make money by holding your money. They make money by using it. They give you a small return for keeping your money there, but then they lend that same money out at much higher rates. And that difference? That's where their profit comes from. So even when your money looks like it's just sitting in your account, it's not still. It's moving. It's working. And most of the time, it's working a lot harder for the bank than it is for you. Which leads to the next question. If banks are making money by lending, what exactly is interest? And why does it seem to exist everywhere in this system? Interest is one of those concepts that sounds complicated, but at its core, it's actually very simple. It's just the cost of using money. If someone uses your money, like a bank using your deposits, they pay you a small fee. That's the interest you earn. If you use someone else's money, like a credit card or a loan, you pay that fee instead. Same concept, two directions. And that direction changes everything. Let's say you put $5,000 into a savings account, earning 2% per year. After 1 year, you make about $100. Not huge, but it didn't require any effort. Now here's where it gets interesting. The next year, you're not just earning interest on your original $5,000. You're earning interest on that extra $100 too. And then the year after that, you earn on a slightly bigger amount again. It keeps building on itself. That's compound interest. Your money starting to generate its own money. Over short periods, it feels small, but over long periods, it becomes powerful. But here's the part most people don't fully realize. That exact same force works against you when you're in debt, and it works much faster. If you carry a $5,000 balance on a credit card with a high interest rate, you're not just paying back what you spent. Over time, that number can grow into $9,000 or even $10,000, especially if you're only making minimum payments. Because every month, interest gets added, and then you start paying interest on that interest. So the system has this built-in imbalance. When money works for you, it grows slowly. When it works against you, it grows fast. And over time, that difference becomes massive. That's why people who build wealth aren't just focused on earning more. They're focused on staying on the right side of this equation, where interest is working for them, not against them. Because once you understand this, you realize something important. Money isn't just about how much you make. It's about how it grows, or how it quietly grows against you. You've probably felt this, even if you've never put a name to it. The coffee that used to cost $1.50 is now $3. The apartment that was $800 is now $1,400, and your grocery bill keeps going up, even though your habits haven't really changed. That's inflation. And quietly, it's one of the most powerful forces in the entire financial system. At its core, inflation means this. Each dollar you have buys a little less over time. It's not just that prices are going up, it's that the value of money itself is going down. A dollar today doesn't go as far as it did 5 years ago. And 5 years from now, it'll go even less. So why does this happen? The simplest way to understand it is supply and demand, but applied to money itself. When more money enters the economy, through things like government spending or central bank policies, but the amount of goods and services doesn't increase at the same pace, you end up with more dollars chasing the same things. And when that happens, each dollar becomes a little less valuable. Now here's what makes this even more interesting. Central banks don't try to eliminate inflation. They actually aim for it. In the United States, the target is usually around 2% per year. Because a small amount of inflation encourages people to spend and invest, instead of just letting money sit still. But for you personally, that creates a problem. If your savings are growing at 2%, and inflation is also around 2 or 3%, you're not really moving forward. You're staying in place, or slowly falling behind. That's why people say cash is like a melting ice cube. It doesn't disappear all at once. It just quietly loses value over time. And most of the time, it's subtle enough that people barely notice. Until something bigger happens. Because every so often, the system doesn't just experience inflation, it slows down entirely. And when that happens, everything starts to change. Everything we've talked about so far, taxes, banking, interest, inflation, all of it operates within a larger rhythm. The economy expands and contracts in cycles, and when it contracts significantly, that's a recession. Here's the simplest way to understand it. An economy runs on a loop of spending. You buy coffee, and the coffee shop pays its employees. Those employees buy groceries, and the grocery store pays its staff. That staff pays rent, and the landlord uses the rent to fix the building, hiring a contractor who then goes out and buys coffee. Round and round. Everyone's spending is someone else's income. A recession is what happens when this loop starts to stall. Maybe people get nervous about the future and start spending less. Businesses see lower sales and start cutting costs, often by laying people off. Those laid off workers now spend even less, which hurts other businesses, which leads to more layoffs. It's a downward spiral, and it feeds on itself. Recessions can be triggered by all kinds of things. A financial crisis, a sudden shock to the system, a burst of overconfidence that finally deflates. But the effect is always similar. Jobs get harder to find, wages stagnate or fall, businesses close, and people feel a squeeze that can last months or even years. Now, here's what's important to understand. Recessions are a normal part of how economies work. They're not fun, and they cause real hardship. But they've happened dozens of times throughout history, and economies have always eventually recovered. The danger isn't that recessions exist, it's being caught completely off guard by one, with no savings, heavy debt, and no understanding of what's happening. And there's another layer here that directly connects to your personal life. During good times, credit is flowing freely. Banks are lending, people are borrowing, everything feels expansive. During a recession, that credit tightens. Banks get cautious, lending standards go up. And suddenly, whether you can borrow money for a car, a home, an emergency, depends heavily on something you may have been ignoring during the good times: your credit score. Your credit score is, at its core, a simple idea. It's a number that tells the financial system how much it can trust you with borrowed money. It usually ranges from 300 to 850, and that number affects far more than just getting a credit card. Landlords check it before approving your apartment. Insurance companies use it to decide your rates. Some employers even look at it during hiring. And most importantly, lenders use it to decide two things: whether to give you money and how expensive that money will be. Because a high credit score doesn't just give you access, it makes everything cheaper. Over time, that difference can add up to tens, even hundreds of thousands of dollars. So what actually determines that number? There are a few factors, but three matter the most. First, do you pay your bills on time? This is the biggest one. Even a single missed payment can drop your score, and a pattern of missed payments can damage it significantly. Second, how much of your available credit are you using? If you have a $10,000 limit and you're using $9,000 of it, that signals risk. It tells the system you might be stretched. But if you keep your usage low, ideally under 30%, it shows control. Third, how long have you been using credit? The longer your history, the more data the system has to evaluate you. That's why people are often told to start early, not to spend more, but to build a track record. There are other factors, but these three drive most of your score. And here's where things get a little strange. To prove you're responsible with money, you actually have to borrow it. Someone who's never used credit at all might be financially disciplined, but the system has no data to trust them. It doesn't reward what you could do, it rewards what you've already demonstrated. Now at this point, you understand something important. Everything we've covered so far, taxes, banks, interest, inflation, credit, it's all about protecting your money, keeping more of it, losing less of it, using it carefully. But there's another side to this system, a side where money doesn't just sit there or slowly lose value, it actually grows. This is where the story changes. Up until now, everything we've talked about has been about protecting your money, keeping more of it, losing less of it, avoiding the traps. But investing is where you flip the direction. It's where you start using the system in your favor. At its core, investing is simple. You take money today and put it into something that can grow over time. When you buy a stock, you're buying a small piece of a company. If that company grows, sells more, earns more, expands, your piece becomes more valuable. And the key difference is this: you're no longer trading time for money. The money itself starts working. Now, stocks are the most well-known example, but they're not the only one. People invest in real estate, in bonds, and in other assets. But the idea is always the same. You're putting money to work now, so it can return more later. And the most important factor here is time. Investing isn't about getting rich quickly. It's about giving your money time to grow. Because of something you've already seen: compounding. Over long periods, investments have historically grown at around 7 to 10% per year. At that pace, money can double roughly every 7 to 10 years. And over decades, that changes everything. For example, someone who starts investing early, even with a few $100s a month, can end up with far more than they actually contributed. Not because they worked more, but because time did the heavy lifting. Of course, this doesn't come without risk. Markets go up and down. There will be moments where things fall, sometimes sharply. And in those moments, most people panic. But historically, the people who stayed in, who didn't react emotionally, are the ones who benefited in the long run. Because over time, the system tends to recover and continue growing. This is the shift. You move from playing defense to playing offense. But there's one more layer to all of this. Because even beyond investing, There's something deeper that determines how far you can go, and it has nothing to do with the market itself. Here's a question that can quietly change how you think about money. What are you actually being paid for? For most people, the answer is simple: time. You work an hour, you get paid for that hour. Work 40 hours, get 40 hours worth of income. And there's nothing wrong with that. It's how most of the world works. But it comes with a limit. There are only so many hours in a week. You can raise your rate, but you can't create more time. And that creates a ceiling. The people who build real wealth usually find a way around that. They stop relying only on time and start creating value that continues working even when they're not. Think about it like this. If you fix something, you get paid once. But if you create something that helps many people, that same effort can generate value again and again. That's the difference. Income from time is linear. Income from value can scale. And once you see that, everything else we've talked about starts to connect. Taxes take a portion of what you earn. Inflation slowly reduces the value of cash. Interest can either work for you or against you. Investments grow when given time. None of these exist separately. They're all part of the same system. And the real advantage isn't just earning more. It's understanding how to position yourself inside that system, so more of these forces are working with you instead of against you. Because once you see that clearly, you start making very different decisions. And that's where everything begins to change. Let's come back to where we started. You earned $3,200 and received $2,407. And the question was simple: where did the money go? Now you know. You've seen how taxes take the first cut, how banks move your money instead of storing it, how interest can either build your wealth or quietly work against you, how inflation slowly reduces what your money can actually buy, how the economy moves in cycles, how your credit score shapes the opportunities available to you, and how investing is what finally puts growth on your side. These aren't separate ideas. They're all part of the same system. And most people live inside that system their entire lives, without ever seeing the full picture. They feel the pressure, the rising costs, the shrinking margins, the confusion, but they never understand why. You just did. And understanding a system doesn't change the system itself, but it changes how you move inside it. You can't stop taxes. You can't avoid inflation. You can't control economic cycles. But you can make better decisions at every step along the way. And over time, those decisions compound into a completely different outcome. Because money isn't just something you earn and spend. It's an environment you live in. And once you can see it clearly, you stop drifting through it and start moving with intention. If this changed how you think about money, share it with someone who needs it. And subscribe, because this is just the beginning. I'll see you in the next one.